Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have David Barse, founder and CEO of XOUT Capital, to discuss a strategy that's focused on identifying which stocks to eliminate via XOUT. David, it's great to see you again. Welcome back to Trade Talks.
Jill, thanks again for having me. It's a pleasure.
All right, you got it. And instead of focusing on picking winners, you aim to identify which stocks to eliminate or X out. Tell us about the XOUT investment philosophy.
Yeah, so we really are trying to address three insights. One, flows of assets continue to go into passive index funds. Index funds in and of themselves are flawed, and it's easier to exclude losers than pick winners. And the third insight is that technological change is one of the most significant forward-facing risks. So we use technology and the disruption that it causes to help us identify who the disruptees are. In other words, we're not trying to figure out who the next Google and Facebook is. We're trying to figure out who Google and Facebook are going to disrupt and just not own those companies.
Right, and XOUT recently published a white paper, The Cost of Underestimating Technological Disruption, that explores how investors are underestimating the rapid pace of tech disruption and its impact on companies across industries. Tell us more about that.
Yeah, so our white paper is available on our website. And what we're really trying to help investors understand and appreciate is, again, this is a long-term secular decline. We have a chart, if you look back at who have been the leaders of something like the S&P 500 for the last 10 years, it probably won't really shock everybody to see some of the names that are now missing from that list versus who's on the top 10 list today. And really our goal is, by eliminating some of those companies that have now fallen short, were once significant market cap weighted positions within an index fund, by just not owning them, you can outperform that index. And so again, it goes to our thesis. It's just easier to exclude them. Just don't own them and let the winners take care of themselves. And that's really what our white paper explored. People just don't appreciate the cost that technological disruption is having on broad-based indexes like the large cap US equity market.
And importantly, the XOUT approach benefits from what it does not hold as opposed to what it owns. I noticed the stocks removed are largely financials and energy names. Why were they X'd out? And is that a broader reflection of the market environment?
Yeah, so look, technological disruption is impacting all companies, including technology companies. We've just X'd out Visa. It's a technology company, even in the global payments space. So we're not just focused on energy and financials. Those are obvious laggards. They just haven't grown at the same rate. And again, not owning a company like Exxon or Chevron, which are large market cap weightings in a large cap US sector in an index fund, you've been able to outperform. AT&T or Verizon are two others. So we look beyond just financials and energy stocks. There are others like media companies that have been scoring poorly in our rules-based methodology.
And David, how often is the XOUT fund rebalanced?
So we do this quarterly. We take the latest quarter's publicly reported information. It goes into our model and it generates a score for us. So as each quarter's new earnings come in, that fundamental data goes into our rules-based methodology and we make new selections. And it's always interesting, like this quarter, I said Visa just came out. Tesla, which had been out, came back in, thankfully before news like their sales of cars to Hertz. So that stock's obviously jumped, and we own a disproportionate amount of Tesla in our portfolio as a result.
All right, David, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.